Right now, the average UK estate agent has more unsold homes sitting on their books than at any point in the last 8 years. If you listen to the mainstream media, read the Sunday papers, or scroll through financial forums, you would think the Great British Property Crash is already here. Headlines are screaming about negative equity, plummeting values, and a looming disaster for anyone holding a mortgage. But is your biggest asset actually at risk? Are we standing on the edge of a 2008-style housing collapse, or is the media simply feeding off fear to sell clicks? Today, we are putting the sensationalism aside. We are going to look at the cold, hard data, the underlying economics, and the reality of the streets. No panic, no clickbait, just an honest, research-driven look at exactly what is happening in the UK housing market right now, and what you actually need to be prepared for as a buyer, seller, or investor. To truly understand whether the market is crashing, we first have to look at the engine that drives the entire property machine, the Bank of England base rate. As we stand today in mid-2026, the Monetary Policy Committee has held the base rate steady at 3.75%. If we look back a couple of years, we saw aggressive, consecutive rate hikes designed to combat spiraling inflation and a severe cost of living crisis. Today, we have finally entered a period of relative macroeconomic stability. Inflation is hovering closer to the bank's target, and the aggressive tightening cycle has ended. However, this prolonged holding pattern means one thing is absolutely certain: the days of ultra-cheap, sub-2% mortgages are firmly in the rearview mirror. We have transitioned into a new era of borrowing, and the market is still digesting that reality. Many people assume that high interest rates automatically trigger a property crash. A crash implies a sudden, catastrophic drop in capital values, people handing their keys back to the bank, widespread repossessions, and double-digit percentage falls in property prices across the board. But the data tells a completely different, much more boring story. And quite frankly, boring doesn't make for a good newspaper headline. If we look at the most reliable trackers of the market, such as the Halifax House Price Index, Nationwide, and the ONS data, they actually show average UK house prices rising marginally. We are seeing annual growth hovering around the 2.2% to 3.8% mark, depending on the specific index you consult. In fact, we recently saw consecutive month-on-month gains. Why? Because slightly lower swap rates in the financial markets have encouraged high street lenders to aggressively reprice their fixed-rate mortgage products. Lenders are competing for business again, slowly bringing buyers who were sitting on the fence back to the table. So, if prices are slightly up or flat, why does it feel so difficult out there? What we are experiencing is not a crash. We are experiencing a long overdue normalization. For over a decade, we had artificially low interest rates that heavily subsidized the cost of borrowing. This drove property prices to eye-watering multiples of the average wage. Now that money actually costs money again, the market is finding its true level. Buyers simply cannot borrow what they used to, which puts a firm ceiling on how much prices can grow. But equally, homeowners are not being forced to sell. Following the mortgage market review back in 2014, lenders were required to heavily stress-test borrowers to ensure they could afford significant rate hikes. That regulation is doing exactly what it was designed to do, keeping people in their homes despite higher monthly payments. Without forced, distressed selling, you simply do not get a market crash. But here is where the nuance really matters, and where the national headlines get it entirely wrong. The UK is not a single, centralized housing market. It is a complex collection of hyper-localized regional economies, and the divergence right now is starker than it has been in a generation. Let us look at the north of England, specifically the north east and the northwest. In these regions, House prices have remained remarkably resilient. Some areas are still posting annual growth close to 7% or even 9%. The underlying affordability in the North means that buyers can still stomach the current mortgage rates. When an average terraced house costs a fraction of what it does in the South, a 3.75% base rate translates to a monthly payment that is still manageable for a dual-income household. Furthermore, property investors are continuing to deploy capital into the North because the rental yields remain strong enough to cover the increased cost of borrowing. Conversely, if you look at London and the South East, the picture is considerably cooler. London has seen consecutive months of annual price falls, and transaction volumes have dropped significantly. This is basic mathematics. When the average property price is upward of £500,000, a higher interest rate severely restricts how much a buyer can borrow. The gap between wages and house prices in the capital is simply stretched to its absolute limit. When you factor in the lingering effects of the April 2025 stamp duty changes, which increased the tax burden for many purchasers and removed vital reliefs, it is easy to realize why the capital's market feels so incredibly sluggish. Buyers in the South are facing a massive affordability wall, and sellers are slowly having to adjust their expectations downwards to secure a sale. This is a complex topic with many moving parts. I am working on a much more detailed, long-form analysis of the UK housing market that I will be uploading very soon. It will take a deep dive into the historical data and future projections. Make sure you hit subscribe and turn on notifications so you don't miss that important update. Thank you for tuning in to the Wealth Ledger. Remember to stay informed, stay rational, and I'll see you in the next video.